We are going to talk today about building generational wealth through real estate investing. One of my favorite subjects. I'm super excited to talk about this. And just a couple housekeeping items for our webinar tonight. As I always say, if you wanted to just listen to a talking head, you could find something on YouTube and do that. My goal is for this to be engaging, and we can engage in a couple different ways. We're going to have some polling questions. We are going to interact with the different gestures, and of course, we're going to have the chat. So you can go ahead and pop questions into the chat as they come up. I will answer all of them at the end, but just so you don't forget, don't hesitate to pop a question in there as we go. It'll obviously catalog that, and we'll come back to them so we don't miss anybody. A couple disclaimers. I'm going to teach to the middle of the class. You know, a lot of teachers are forced to teach to the middle of the class. You've got your overachievers, you've got those maybe that are struggling, you've got those in the middle. You can't possibly at the same time teach to everybody. So I understand that there's going to be some people here watching that own a whole lot of properties, and there's going to be some people that have yet to purchase their first property. But we're going to kind of teach to the middle. So some things, you know, you may get bored if you're really advanced. Some things may be over your head if you're really beginner, but that's why we've got the chat. So hopefully we can engage and get a little bit more into the weeds if there are specific questions. Also, I just want to put it out there that I am laying a framework. We're going to go wide, not deep. So we're not going to get into something super, super specific and tactical. We're going to be more strategic and high level and goal setting and really understanding real estate investing at a high level. And we're going to dig a little bit deeper at the end. But again, this is going to be more high level. And there will be future webinars where we go a little bit more into the weeds. So a couple memes to start us off here. You can't buy happiness, but you can buy real estate. And that's kind of the same thing. Money can't buy happiness, but it can help. I like this right now in our COVID world, looking at the map for some weekend travel ideas. I think a lot of people right now are having travel plans that they thought would be okay are canceled. We just had our trip to Mexico at the end of August canceled, unfortunately. So people are getting a lot more comfortable in their homes. And I think we're seeing a lot of buyer demand, probably because people are realizing, wow, if I'm spending this much time in my home, I better like it, right? So who comes to mind when you think about real estate investing? How about this guy? Who's that? That's Robert Kiyosaki, Rich Dad, Poor Dad. How about this guy? It's Dave Ramsey, right? Financial Peace University, Total Money Makeover, huge radio show. How about this guy? Right? Yeah, Trump owns golf courses, hotels, all kinds of real estate. But you're forgetting someone. You too can be a real estate investor. It's a lot less complicated than you might think. And really the goal of tonight is to make real estate investing an accessible tool for all to be able to gain financial freedom and build generational wealth. Courtney's going to go ahead and pop a Calendly link into the chat window where you can actually book either a call or a Zoom meeting with me, that if you have more questions and you want to dive deeper into a specific scenario, I would love to be a resource to you. You can also sign up for our newsletter, which is on our website, jordanbennettonline.com. And then you can get our market update that we send out every 2 to 4 weeks and just stay in touch with what's happening in the real estate market. So today we're going to cover a few things. We're going to cover just a quick market update. Anytime we talk about real estate, people always want to know what's happening in the market. So even if I just did one last month, I always like to give just a quick update. We're going to talk about why investing in real estate makes sense and does it make sense. We're going to look at some different types of real estate investments, how to find a good deal, some action steps that you can put into place literally as you walk away from this webinar. And then of course, we'll do some Q&A at the end. So what does it mean to be a property investor? This is a fun one. My favorite one is, what my friends think I do. You know, if you own property, you must just be able to lie on a hammock in the Caribbean. Not really. A lot of driving around. Thankfully, I don't end up doing a lot of the maintenance on my own property. Some people do end up in that position. But just a little bit about myself. I've been selling real estate for 12 years. Started my career in accounting. Have personally bought and sold around 35 million in real estate assets, both in partnership and on my own. Why do I tell you that? Just to give you a little bit of credibility of, why should you listen to what I'm saying? and what have I done, that's real estate related. This is my why, my family. That's my wife, Kaylee. We've been married for 13 years now, and my son and daughter, Theo and Emma, who are 12 and 9. They really are kind of a big part of the reason that I do what I do. And I love what Warren Buffett says. Warren Buffett has a couple things that just stay so top of mind for me. And one of them is, don't invest in what you don't understand. Invest in what you know. There's a reason that Warren Buffett has tended to stay out of, the tech sector. He doesn't understand it, So for me, real estate is what I know, and that's why I have pursued investing in real estate as a way to build wealth. And just real briefly about my investing background, started selling real estate in 2009. In 2010-11, I was introduced actually to a group of investors that were looking to buy distressed properties, fix them up, and resell them. So in connecting with this investor group, I started helping them find properties, and then I'd see them rehab them, and then I would relist them for this investor group. I did this probably 4 times, and then I started to get the itch, thinking, this is not that complicated. I think I can do this. And I started to do that back in late 2012. Since then, I've done about 40 rehab projects and have a handful of rental properties, including multifamily in Orange County. And I'm just a huge believer in real estate as a vehicle for building wealth. So we'll get a little bit more into that, but a quick market update for you. What is happening in Orange County right now? Supply is super low. We just don't have enough homes on the market. You can see here where we were last year, over 7,500 homes on the market. Today, we're down below 5,000. Really significant drop in inventory, just not enough homes on the market. And yet, demand is on fire. So we saw demand come down really significantly during COVID, of course. A lot of fear, a lot of panic, everything was shut down. But then it just came back roaring dramatically. And of course, we're seeing interest rates just breaking new records. It seems like every other day. 30-year just dropped below 3%, which we haven't seen in over 50 years. So what does that mean for expected market time? Things are flying off the shelf. They say that if it takes less than 60 days on average to sell a home, that's considered a hot seller's market. So we have never seen luxury this hot. To be in a hot seller's market up to 1.5 million and still a seller's market all the way up to 2 million is uncharted territory. And again, just mentioning interest rates, on the 15-year, we're down at around 2.5. So it's pretty remarkable. So why invest in real estate? Why are we having this conversation? Let's revisit the goal. I believe real estate investing can create financial freedom and generational wealth. What does that mean? What do those two big words mean? Well, freedom is what it means to you. For some people, freedom might be taking an international trip every year without straining the budget. Could be paying for your kids' college tuition without taking out a loan. Could be retiring 10 years before you initially planned on. It could be contributing to the needs of others. It could be donating to a worthy cause. It could be buying a parent a home for them to live in. It could be a number of things. For me, it's time. I think financial freedom means time freedom. It means not having to work and coming to a point where you have the freedom to really pursue your passions. Generational wealth, of course, means enough wealth to pass on to the next generation. It means you've built a portfolio that not only can sustain you, but can actually pass down to the next generation and potentially even the generation after that. So why real estate versus other investments? One of the great things about real estate is it checks a lot of boxes. Okay, when you're looking at stocks and bonds, they each check some different boxes. Real estate really checks all of them. You can get a good cash on cash return. You can get equity buildup. You can leverage it. It is a hard asset and it's tax advantaged. That's really difficult to find in different asset classes other than real estate. So no matter how you feel about real estate, I would argue that probably even your financial planner would agree with me when I say that it should compose some portion of your portfolio. In fact, this is actually my actual portfolio about 6 to 9 months ago. It's a bit dated. But what you want to look at is having real estate as a part of your portfolio. Of course, I'm very heavily weighted in real estate at about 60% of my assets because that's what I play in every day, and it's something I'm really comfortable with. I'm probably a little too heavily weighted in that direction, but I think the point here is that it's important to have it as some portion of your asset allocation, and you need to determine what level you feel comfortable with and makes sense for your given portfolio. The other thing that you want to look at is your diversification between paper assets or soft assets. These are your stock certificates, your cash, versus your hard assets, right? Which are gold, oil and gas, commodities, and of course, real estate. So you need to determine where is, based on your long-term goals, what should that allocation be? One of the great things about real estate, I say it's the most able investment. It's accessible, appreciable, rentable, improvable. One of my favorite things on this list is that it's livable. The thing about the stock market is that a stock can go to zero. You can lose it all. Real estate generally doesn't do that. We do see swings, but it tends to be a whole heck of a lot more stable. And it's something that you can live in, and people always need a roof over their head. The other thing I love about real estate is it is leverageable. And we'll talk a little bit more about leverage, which is the exertion of a force by means of an object used in a way that multiplies the outcome of one's effort. In this meme, the leverage is this lady. She's helping, accomplish a task that possibly this fellow can't do on his own. When it comes to capital, leverage is the use of borrowed capital as a funding source to amplify returns from an investment. Simply said, it's doing more with less. Some of the pros of leverage: you get more bang for the buck, you can put less money down, and you can earn income from assets that you would not normally be able to afford or control. Some of the cons is that it does add an extra layer of risk. So we're going to do a real quick little whiteboard demo here of how leverage works. Okay. So let's say that you have a $10 widget that you purchase, and immediately after purchasing that $10 widget, you can sell it for $15. Okay. So if you sell it for 15 and you bought it for 10, I'm not going to show my work here. I'm going to go against what the teachers always told me to show my work, because we can do 15 minus 10, right? What's our profit? Our profit, I lost my cursor. Oh boy. We're having a little tech challenge here. My apologies, bear with me. All right, everybody, my apologies. We might have to shut this down and restart it here. Okay, in an effort to not have that freeze up on me again, I'm just going to speak it out instead of writing it out. But let's say you buy a widget for $10, you can sell it for 15, your profit is $5. You made $5 on a $10 investment. In other words, you earned 50%, right? 5 divided by 10. You made 50% on your money. Now let's take that same situation, but instead of buying that widget with $10 of your own money, you're going to borrow $9 from a friend. In borrowing that $9 from a friend, you have a great friend that's going to hook you up with a loan. It's not free though. He's going to charge you $1 to borrow that $9. So now you have a cost of borrowing of $1. So now your profit, you have to factor in that cost of capital. So that $5 profit is decreased by $1, which is your cost of borrowing. So your actual profit now is $4. Now you might ask, why would I want to decrease what I make? Why would I want to make $4 instead of $5? Well, let's look at it. You've now used $1 of your own money and $9 of your friend's money. If you can convince your friend that you're going to pay him that $1 upon the sale of that widget, your out of pocket was only $1, right? You borrowed $9, you put $1 of your own, and you repay that capital at the end, that $1 that you owe. So you've made $4, right? Because you have to pay for the capital. So instead of 5, it's 4 on a $1 investment. Well, 4 over 1 is 400%. So instead of making a 50% return on your money, you've made a 400% or 8x what you could have earned without leverage. So that's leverage in action. And of course, that's positive leverage where it works in your favor. Leverage can also work against you if you are over leveraged or if the outcome doesn't work out like you thought it would. So what are some of the types of real estate investments? There are all kinds of real estate investments out there. I'm going to just touch on some of the more common ones that you might come across more commonly. So you've got your short-term rentals, your long-term rentals, your fix and flips, your investment trusts, and then if there's crowdfunding. So our first poll question is, what type of real estate investing most interests you? Is it long-term investing, short-term, REITs, crowdfunding, or fix and flips? And I have a prediction, but I don't want to skew the results. So I'm not gonna say it until we get some answers. All right, 5 more seconds. All right, so we were kind of split about 50-50 between long-term rentals and fix and flips. So let's take a look at those. All right, we're going to start off with your short-term rental. So your short-term rental, when I say short-term rental, I'm talking your Airbnb. This is your hands-on, hospitable investor. So this is a lot like being a hotel owner, right? Some examples of short-term rentals would be literally if you had let's say, I knew somebody that had a 5-bedroom house and rented out 4 of the bedrooms. So get this, they rented out each of those bedrooms for about $1,000 a month. So they were bringing in $4,000 a month for their 5-bedroom home, which was actually about the same as their mortgage payment. So by doing the short-term rental, they were actually able to pay their entire mortgage. I'll give you another example. I have a client that has a casita on their property, and they actually rent out their casita on a weekly basis, and they bring in about an extra $2,000 a month in income from doing that. Another example would be your classic Airbnb, right? You buy a property, you rent it out on either a weekly or a monthly or a weekend basis, and then you have a place to stay as well. Some of the pros of being a short-term investor in this capacity that we're talking about, you're typically paid up front. You get a vacation home for yourself. It can be very lucrative depending on the season, generally going to get a greater return than a long-term rental. Some of the cons, income might not be as stable, right? This is much more vacation driven. And so there may be seasons where you're packed and there may be seasons where it sits empty. A great example is the desert. I've had some clients and friends that own properties out in the desert. They make $1,000 a night during Coachella, right? These big music festivals. But then there's other times of the year when it's sitting empty for weeks, sometimes months at a time, right? There also may be rules and regulations. You've got to consider, what does the association allow? What does the city allow? You need to furnish it and consider that cost. And of course, there's some extra costs associated with having a short-term rental. How about your long-term rental? This is kind of more your buy and hold for the long term, more kind of your apartments, multifamily. This is for your investor with a longer term vision. This is going to be a little bit more consistent, right? When you're doing the short-term rentals, you might not necessarily know where your next renter is coming from, right? In a long-term rental, you've got, of course, a legally binding lease, tenants pay their own utilities, and you're doing a little bit more background work on the tenant as well, versus seeing maybe their 2 reviews on Airbnb and then clicking the approve button. Some of the cons, there's less pricing flexibility. You can't change the terms of the lease. You're typically bound for the year, which is your standard lease. Can't change the price. Can't up the rent at Christmas time or July 4th weekend, right? It kind of is what it is. You might be dealing with more delinquent tenants because there's no protection through this online platform like Airbnb or VRBO, and you have less control over the home, right? Of course, you can't access it or use it for your personal use. So let's talk fix and flips. Fix and flips are probably the sexiest thing to talk about. Everybody watches the shows, right? Flip or Flop, Fixer Upper, I think everyone in the country knows, the gains. This is the interesting thing about fix and flip is it's really not, people look at it sometimes as like, oh, it's like an investment, like putting money into the stock market. It's really not. When you're buying a home that needs work, fixing it up and reselling it, it's really a full-time job you're taking on, right? There's a lot of work that goes into it, a lot of time, but you can make a pretty good amount of money in a short period of time, which is our first point here. Fast turnaround, immediate equity, a lot of opportunities. Some of the cons, it's much greater risk, right? You can have unanticipated expenses, holding costs, difficulty selling, the stress, time, effort. I had a client that executed on their first flip and it went completely sideways. They got red tagged by the city. They ended up having to hold the property for almost a year and a half, which unfortunately bled them dry on their funding. And they ended up having to sell the property at a significant loss. And it was really painful. So you don't hear as many of those stories on the TV shows, and you do need to consider that there is a great deal of risk associated with those. So question, should you buy and hold or should you fix and flip? What is the best path, to building wealth? I'm going to give you an attorney answer, which is it depends. It depends on a couple things, right? You've got to look at what's your capital allocation, right? Sometimes if people want to get into more long-term rentals, the money is staying put, right? You're not going in and out and making quick gains in equity. It's more of a longer-term strategy. So sometimes people start by fixing and flipping to make some initial capital and to build up the nest egg. And then they kind of park the money after they've built some capital in the longer-term rentals. You've got to define your strategy, look at your risk and return ratio. In other words, on the spectrum of risk and return, where are you comfortable as far as what amount of risk are you willing to take on? And looking at your skills and time constraints. The reality is if you have a full-time job, it's unlikely that fixing and flipping is going to make sense for you unless you have a lot of flexibility. Of course, everyone is working remote right now, or a lot of people are. So there may be opportunities that are opened up to you now that weren't available prior. But you've got to look at, are you self-employed? Do you have a lot of flexibility in your schedule? Can you leave and go meet a contractor at a certain time or place? So, just breaking it down, your buy and hold is your longer term appreciation. Your fix and flip is your quick payoff. One is more passive. Nothing is truly passive if it requires any of your time, energy, or mind space. But buy and hold is more passive. Fix and flip is much more active. One is a little bit more safe and stable. The other is higher risk, but higher return. One's slow and steady. One is the quick turnaround. So let's look at another poll question here. I have to pay tax when I sell my investment property for a profit. Do you have to pay tax when you sell your investment property for a profit? Might be a trick question. Let's see. Okay, so we've got about 2/3 of people saying that that is false and 1/3 saying that it is true. So I will answer the question. It's another, it depends. Do you have to pay tax when you sell your investment property for a profit? Not necessarily. So the correct answer is false. If you sell that property within a 1-year period, yes, you do. It's ordinary income, taxed at the same rate as your regular income. If you hold it for longer than a year, it's capital gains income, slightly lower rate, but you still pay tax. If you 1031 exchange, which means if you sell one property and within 6 months close on another of equal or greater value, you actually can defer that tax theoretically indefinitely. You could continue to exchange or hold the exchange property indefinitely, and there will be no tax on that. I'm not going to go deeper into the 1031 exchange because it is truly an entirely separate webinar, a lot of content. We will do that at some point. The REIT, Real Estate Investment Trust. This is better for your hands-off market watching investor. A real estate investment trust is a lot like, think of a mutual fund. A mutual fund is basically a basket of different stocks, right? These stock pickers have picked a whole bunch of different stocks to put in a mutual fund. When you buy that mutual fund, you're getting exposure to a whole bunch of different companies. Well, a real estate investment trust is the same idea, just with real estate. Instead of a bunch of stocks, you might have a medical building and an apartment building, et cetera, et cetera. You're going to get access to a whole bunch of assets that you wouldn't typically have access to, but of course you have no control over them. You're basically placing your money with somebody who's making those decisions. Some of the pros are that it's very liquid. It accomplishes what we talked about as far as having real estate as a part of your portfolio without really being involved or being hands-on. It gives you access to assets that you wouldn't typically have access to. Some of the cons are that it's highly sensitive to interest rate fluctuations. And one of the big ones is you don't have any control. It's somebody else controlling that real estate and making those decisions on your behalf that you are not going to be able to call up and speak to on the phone. And the final one is crowdfund. I only mention this because we are seeing some of this out there. I haven't personally been involved with the crowdfund, but it's similar to an REIT, but on a much smaller scale. Think of a whole bunch of people, maybe friends or acquaintances, getting together, pooling their money, to get into a property. Just like a GoFundMe, where someone's trying to raise money for a specific cause, except that cause would be the purchase of a real estate asset that maybe would be too large or too complex for somebody to pursue on their own. So how do we find a good deal? We talked a lot about, buying properties with different goals or different end games. But at the end of the day, whether it's buy and hold, whether it's fix and flip, whether it's short-term, long-term, whatever it may be, everyone wants a good deal, right? There's an expression, which is that you make money when you buy it. If you buy a property right, the right location, the right neighborhood, the right price, you're going to do okay. Versus just crossing your fingers and hoping that the market makes up for a bad decision. So the first thing you need to do is identify your criteria. This seems pretty obvious, right? But a lot of people miss this step. They just say, I want a good deal anywhere. Well, that's not going to work. First, you want to identify your geography. You want to identify your asset type. Is it going to be a single family, multifamily, a condo? Is it going to be land? Are you going to do entitlement, condo conversions, all different kinds of things to consider like this. I have one client who is specifically targeting investing in properties where he can build accessory dwelling units, also called ADUs. I have other clients that are buying vacation rentals in the desert. I know other clients that are buying apartments out of state in Tennessee. So there's all kinds of options, and you really want to figure out what's your criteria, what are your goals, and start high level before you start, putting your finger on the trigger and getting itchy to do something. The market, you want to understand the market in whatever area, whatever asset class that you're going to invest in when it comes to real estate. You want to look at jobs. How many millennials are there? What's the population? Are people coming there or are they leaving there? What are the major companies that are there? What kind of job growth is that area experiencing? Is it recession proof? What kind of industries are present? Is there enough diversification of those industries, right? When oil and gas got hit really hard, there were parts of Canada and Texas that just got demolished when oil prices went super low. It killed a lot of people because that was their sole industry. Neighborhood. We've all heard the expression location, location, location. You want to understand the neighborhood you're buying into, the surrounding areas, the crime rates, the amenities. What are the comparable rents if you're looking at that long-term play? Do you have to know every neighborhood inside and out? Absolutely not. I sell across hundreds of different neighborhoods across Orange County. I can't possibly know every one of the thousands of different tracks inside and out, but I know how to find out what I need to find out to determine if a property purchase makes sense or not. You want to look at rentability. You want to understand if there's any rules against certain types of, especially short-term rentals is the big rage now. Some cities are really against them. Some cities are a little bit more lenient. You want to look at what are the actual rents versus what could something rent for. You want to look at the tenant versus owner occupied ratio in a neighborhood. And of course, the condition. This is a big one. As a retail buyer, if you're just buying a home that you're going to live in and it's going to be your primary residence, most people are looking at the countertops and the color of the paint and the carpets and that kind of condition at very surface level. Unfortunately, few buyers consider the big ticket items like the roof and the HVAC and the plumbing. and the electrical panel and the foundation and the wood repairs and the landscape. So you want to look at those bigger ticket items and think like an investor, think with your pocketbook, not with your emotions. And then finally, of course, you want to make sure the math makes sense. In fact, this slide really should be first and last, because the first thing that you're going to do is probably some rough napkin math and determine, does it even make sense to do the due diligence on this property? Could this property be a candidate either for a buy and hold or a fix and flip? And then once you've done all your due diligence, then you're really going to sharpen your pencil and get much deeper into those numbers versus just eyeballing them. So we're going to do a little bit of looking at calculating the deal. We're going to do some numbers. I promise I will not take too much time on this so that your eyes don't glaze over. There are only three types of people in this world: those who can count and those who can't. And I know you can do this math. Just listen to Bill Murray. So three of the most important analyses that you can do on a property are looking at the cash flow, the return on investment, and really I'm just throwing out the 1% rule. There was a point in time when the market was a little distressed prior to this huge run up in prices that we've seen, where investors would look at a property based on the 1% rule. The 1% rule means that the property will actually generate 1% of the purchase price in rent each month. In other words, if you were to buy a piece of property for $150,000, you would expect the rent to be $1,500 a month. If you bought a $200,000 property, you would be looking for the rent to be $2,000 a month. The 1% rule doesn't exist in Orange County. Our rule here is about 0.5%. That's probably your protocol, or that would be par for the course. If you can do better than that, great. But that's really what we see here. And there are parts of the country where you can get close to that 1% rule, but generally not. But it's just a rule of thumb, just to kind of keep in the back of your mind. So let's look at the ROI. So return on investment is effectively your net profit, what you made on the deal over and above your initial investment, divided by your out of pocket. What was the money that you put into the deal? I'm going to actually give you an example of a real transaction that I looked at not too long ago, probably 3 months ago. I was looking at a property in San Clemente that could be resold for about 1.5 million. It had a 965 going in price. You might be asking, why the huge spread? Well, this property had major foundation issues. Foundation was down 14 inches from the front of the property to the back of the property. So significant geological work, which is why that cost of repair is so high. So what I'm going to do is I'm going to walk you through this worksheet in each section and help you understand how do you analyze a potential rehab project. And I want you to just quickly understand why I passed on this deal, even though it had a predicted 18% return. And it was about the time of the holding time. This particular project had about an 18-month holding time between getting all the work done, getting it back on the market, and selling it. So if you annualize an 18% return, you take 18% and you figure out what is that on a yearly basis, it's really about a 12% return, which isn't a bad return on an annualized basis. However, the amount of risk and energy and time that was going to go into that deal didn't really justify that spread. In other words, if you could make 8% on a deal, but accomplish that deal in 3 months and do that 4 times a year, then your annualized rate of return is 8% times 4, which would be 32%, much more attractive than say a 12%, right? So these are things that you need to look at. So this spreadsheet basically breaks out all of the different costs that go into a deal. So you're starting with your ARV, which is your after repair value. That's what you think you can sell it for. You always want to be conservative in determining this number and work with a great agent like me to figure out what is a realistic number. You know what you can get it for generally. That's what you've negotiated on the contract. And then you've got to figure out all your costs. So your first costs are your cost of purchase. What does it cost to get into the deal? Is there a finder's fee? Are you doing inspections, appraisals, closing costs? And you need to figure out your cost of purchase. The next cost section you're going to look at is your repairs. You're looking at your minor repairs, your major repairs, structural, appliances, landscaping, etc. Again, you are better off overestimating these numbers and being conservative than underestimating and finding out you had a much lower rate of return at the end of the deal because you underestimated something. You're going to look at your carrying costs. These are things like your taxes, your insurance, your utilities, your debt service if you're borrowing money, and your property upkeep. And then finally, you've got to look at the costs associated with selling the property, right? If your idea is to go into something and get out of it, you've got to pay closing costs twice. You got to pay your purchase costs, and then you've got to pay your selling costs. Things like commissions, home warranty, title and escrow, and closing costs. All that is going to back into your discount or profit number. The next thing we're going to look at is cash flow. How do you calculate cash flow on a property? So this is more your buy and hold. You're buying a rental, something you're going to keep for possibly the long term and generate a recurring monthly income. So this is a deal. This is a real deal as well. This is a property in Orange, $1.1 million purchase price, 25% down, 75% loan to value. This was a 4-unit with all of the rents outlined here. You add all those up together, multiply it by 12 months, and you've got your gross annual income. Typically, most of the time, you want to calculate some kind of vacancy allowance. Nothing's going to be rented 100% of the time. You're going to get your net rental income, and then you're going to back out all your expenses, your property taxes, insurance, if you have any management fees, maintenance, repairs, utilities. And you're going to find out what's called your NOI, which is probably one of the most important numbers to determine when it comes to buying an investment property. What is your net operating income? Then what you're going to do is you're going to take that income and divide it by your investment. Now, is your investment 1.1 million? Only if you're buying it for cash. If you're leveraging it and you're putting down 25%, you're actually dividing your net operating income by your down payment, which would be 25% of 1.1 million, right? And then you've come up with what's called your unleveraged cap rate. Now, anytime that the cost of borrowing money is less than the unleveraged cap rate, you're going to experience something called positive leverage. It means leverage is going to work in your favor and actually increase your return. So in other words, we take that net operating income, we take away what's called the projected debt service. What are you going to pay on a monthly basis for that mortgage? You're going to add back the principal pay down, because remember, the part of your mortgage that you're paying down is effectively building equity in the same way that you would build equity by appreciation, except instead of appreciation, you're just paying down the mortgage. And you're going to get your total leveraged return. You divide that by your down payment. And I'm sorry, in this case, when we did the NOI, we took the unleveraged cap rate we calculated by taking the NOI divided by that full 1.1 million. When we come up with the leveraged cap rate, we're taking that leveraged total return divided by your down payment. Hopefully I didn't lose everybody on this. Happy to get more into detail on this if you have additional questions after this webinar. Let's look at some funding options. Most people don't have $1 million in the bank ready to execute on $1 million purchase. Most people are getting some kind of funding. The great thing about financing is that your bank is your best partner. The bank is an amazing partner because they're lending you money in this market for somewhere between 3 and 4%. And when that property appreciates, they get none of the appreciation. You get all of it. So they charge you very little amount of money to borrow their money, and then you get to make all the return. On the opposite side of that coin, if the market falls apart and drops by 50%, guess who's left holding the bag? The bank. So you get the best of both worlds. If the market falls apart and there's a zombie apocalypse, and your property that you paid $1 million for and borrowed $900,000 is now worth $500,000, and you can't make your payments, the bank will take back that property worth $500,000 and basically call it good on your $900,000 loan. So the bank is your best partner you will find. So we have another poll question here. It's a true or false question. I need a minimum down payment of 20% to purchase investment property. Is that true or is that false? give it a couple more seconds. Okay, so most people said false, about 3/4 of you. And that's correct. Most conventional lenders will ask for about 20 to 25% down. That's your conventional lender. There are other kinds of lenders, portfolio lenders, credit unions, and hard money are three, kind of outside of the box kind of lenders. You can literally get 100% financing from some hard money lenders, depending on the asset that you're buying and if they deem that that deal makes sense for them on that property. Your conventional lenders are looking more at you as a borrower, and your hard money lenders are looking more at the property than they are at you, the borrower. And we've got another follow-up true or false question. Some properties cannot be purchased with financing. Some properties cannot be purchased with financing. In other words, the lenders will not lend. Is that true or is that false? 3, 2, 1. Okay, we had everybody say true on that. Now this is interesting. So again, reflecting back on your conventional versus non-conventional lenders, your conventional lenders absolutely will not lend on certain properties. If there are major foundation issues, if there's water damage, broken windows, an empty pool, just to name a few, those would be some reasons that a property may not qualify for conventional financing. However, there are alternative financing that can be arranged on just about any property. In other words, I've seen hard money lenders make loans all the way up to 90, 95% loan to value on a property that was sliding down a hill because it was purchased at a low enough price. So in other words, a hard money lender is more of a make sense lender. It's not so much about meeting the exact guidelines. It's about a smart investor looking at this deal and saying, hey, this house is falling down a cliff. However, the land alone is worth $1 million. And this property can be purchased for $600,000. Well, do you think a lender would be willing to lend $500,000 on this property if the borrower is putting down $100,000 and the lender can validate that the land alone is worth $1 million? Absolutely. Most hard money lenders will make that loan depending on things like the loan to value, what is the experience of that borrower, et cetera, et cetera. So it's more make sense lending, and sometimes things that you would have never thought possible as far as lending are possible, which can be surprising for folks. So looking at just a couple of the different funding options, I mentioned a couple times the conventional loan. The FHA 203K is also called a rehab loan. This is an FHA product, but basically allows for a holdback of additional funds by the lender to put towards the rehabilitation of the property. There's private and hard money lenders. A HELOC is basically taking out your home equity line of credit that you would actually take out on your primary residence and use that cash to purchase the investment property. And then there's what's called a joint venture or partnerships. Literally think getting friends and family together and saying, let's buy this together. So let's look at some risk factors now that we've come this far. Over leverage can be a major risk. I mentioned that deal that this client I had to hold for 18 months because they couldn't finish the rehab. Well, that killed them. They were over leveraged. Their payments were significant because they had borrowed money at a really high interest rate, and being over leveraged effectively killed the deal for them. Surprise expenses, making sure you know what's going into that flip and not, or buy and hold, and not underestimating the cost of the project. Unpredictable market. Anytime you buy anything, you're exposed to what's called market risk. That means that the market could fluctuate, right? You could buy a home today that you're not going to sell for 6 months from now, and the market could fall apart in the next 6 months, or the market could boom in the next 6 months. In fact, the first property I ever purchased to rehab, this worked in my favor. I made an offer on a property that was a short sale. The bank did their appraisal. They valued the property, approved our offer, which was, a really good deal. However, it took them almost 9 months to come to the point where they formally approved that short sale. But guess what? In that 9 months, the market had come up almost 15%. However, the bank approved that sale based on the value from 9 months ago when that appraisal was done. So in that case, the unpredictable market worked in my favor. However, it can also, of course, work against you. Vacancy is another thing that a lot of investors don't consider. Don't anticipate if you're buying a rental that you're going to have a renter in there the next day if it's a vacant property. You want to look at average days on market for rentals and get a really realistic sense of what something might rent for and how long it will take. Lack of liquidity. This is another thing. Count the cost. Some people go into a deal and really don't budget for all of the things we looked at on that spreadsheet. They forget, oh gosh, there's holding costs, there's buying costs, there's mortgage payments, there's all of these different things that can cause a lack of liquidity, which means you're stuck with a project that's 70% complete and you have no money left. Timing, we talked about, and that can definitely kill the deal. But remember, at a high level, no risk, no reward. However, you want to risk wisely. There is something called calculated risk, mitigated risk. You do things to decrease the risk as much as possible and do it in such a way that you fully can wrap your head around what are all of the risks. If you take a calculated and mitigated risk, you are likely to not get stuck holding the bag. So finally, getting a little bit tactical, let's look at finding the deal. There's really at a high level 2 kinds of deals, on market and off market. A lot of consumers are misled into thinking that short sales and foreclosures are some kind of, you have to go through some secret gateway to find these. Short sales and foreclosures, 99% of the time, are advertised on the open market. That means they're on the multiple listing service, available for everyone to see. There's also auctions, trust sales, probates, bankruptcy sales. Most, if not all of these sales are generally required to be marketed on the multiple listing service, and they are online, available for all eyes to see. Your off-market deals, oftentimes you can, in certain cases, get a better deal from an off-market sale. An off-market sale is really an inefficient market. In other words, I like to think of it as kind of an ethical version of insider trading, right? If someone's insider trading, they have a tip, they know about something before it's going to happen, and they buy a stock based on that insider information. Well, when it comes, that's illegal, right? What we're talking about is not illegal. It's purchasing a property that hasn't been marketed on the open market. Those are out there. They are difficult to find. It's a little bit more of a needle in a haystack proposition, and it's much more relationship based. So what are some action steps that you can take today? You've decided, hey, I like the idea of investing in real estate. I want to have real estate as a part of my portfolio. I either want to invest for the long term or the short term, but what do I do now? I've got some of this information. What's my next step? Well, there's really 3 pieces to purchasing property. There's finding it, funding it, and in some cases, if we're talking about distressed properties, fixing it, right? So the first thing you want to do is find it. How do you do that? You build great relationships. Relationships with attorneys, power partners, wholesalers, a great real estate agent, bird dogs. Those are basically anybody who can point you in the right direction of a deal. I'll give you a great example. I have a good friend of mine who is looking at investing out of state. So what did he do? He did a ton of research, talked to a lot of people on the ground in a number of different states. He decided specifically on Indiana. What did he do then? He started having conversations with home inspectors there. He had home inspectors actually refer him to some good lenders and agents and contractors. He followed the rabbit trail, did a whole bunch of research on that market and talking to a whole bunch of different people to get a diversified approach and understanding. And he decided that's where he wanted to go. So he's building his finding team right now. You got to build your funding team. How are you going to fund the deal? When you come across an opportunity, one of my favorite expressions is that success happens when preparation meets opportunity. You need the opportunity, but when that opportunity comes, if you're not prepared, it's going to fall through your fingers. So what does it look like to build a good funding team? You want to have a relationship and a full underwritten approval with a regular conventional lender, a hard money lender to finance those deals that maybe can't qualify for conventional financing, and partners. What do I mean by partners? It could be me, could be your uncle, could be a good friend, could be a coworker, could be your kid. All different kinds of options to figure out how do you come up with that seed money when the deal presents itself. The next part of your team is your fixing team. You want to build a roster of an architect, a structural engineer, maybe a soils engineer, a general contractor, probably a handyman, a home inspector, an appraiser, probably some subcontractors, a termite company. These are going to be your team that when you come across that opportunity are going to help you turn that piece of coal into a diamond. And the fourth step is really taking action. It's starting high level. It's figuring out what, I'll pause for a sec. I was having a great conversation with another real estate investor recently, and I asked him, this was actually pre-COVID, and I said, hey, our market is just booming. How do you make a decision on if it's time to buy more real estate, to sell what you have, to reallocate? What do you do? And he said, simple. You figure out what percentage of your portfolio you want invested in real estate, and you stick to that plan. If you decided I want to have 10% of my portfolio invested in technology stocks, well, if tech booms and all of a sudden prices have come up so much and your portfolio is on fire, and now 30% of your portfolio is in tech because those stocks have done so well, your planner's job is to reallocate that portfolio. So now he's going to sell some of that tech stock to get you back down to that 10% allocation and buy some other stuff, unless you change course and decide, you know what, I'm okay with having 30% of my portfolio in tech and being a little bit more exposed to that sector, right? So what's the point? Taking action means starting with that, figuring out in what capacity do you want to be invested in real estate? Where do you want to be? What are your long-term goals? What are your short-term goals? Are you more growth oriented? Are you more cash flow oriented? Is retirement near and you need income? Or is retirement far away and you want to grow wealth as quickly as possible and you're willing to spend the time and energy and money to do so? So once you come up with that plan, I would love to have a conversation with you. If you are ready to invest, you want to learn more about how to get started, have conversations about different areas, different rates of return, different asset classes, and get more into the weeds, I would love to help. I'm going to refer you back again to the chat window that's got my Calendly on there, and you can literally pop an appointment right on my calendar right now, or at a future time. Happy to do a Zoom meeting with you or a phone call. And now we're going to go ahead and wrap up with some Q&A. Here we go. So our first question is, where do you find fix and flip properties? That's a great question. And we talked about a number of those different sources. One of the things I like to do, and this is some of my secret sauce, so I probably shouldn't be advertising it, but I'm not afraid to share. I do keyword searches. So I actually look for properties that have verbiage in the listing, which you can't do as a consumer. It's more difficult. There might be some backdoor way you could do it, but really it's an agent level tool, which is to search for keywords. And I search for keywords like TLC, investor special, cash only, mold, foundation issues, those kind of terms that are going to lead me to properties that literally have those terminology in the description, which is going to lead me to believe that there's probably a property that is ripe for rehab. The other thing I'm doing is just constantly combing through the inventory. So the on-market inventory, I'm always reviewing it. And Candidly, this is where it really makes a difference. I'm, of course, an investor and a real estate broker. So this is my bread and butter. I see a lot of inventory. I understand values. If that's not you, which is probably not, it's really a matter of partnering with a great agent that you trust that's going to shoot straight with you, which love to be that person for you. And that's literally going to that agent and saying, hey, what do you think of this property? How would it comp out? What would the after repair value be? What kind of spread do you think we would have here? And then your off-market deals, that's all relationship building. So I find fix and flip properties really by being in relationship with all kinds of different folks that are in a position to potentially refer me those properties. The next question was, can you do a 1031 exchange with a primary residence property that has an ADU? You cannot 1031 exchange a primary residence. There are two different tax treatments. For investment property, you can do a 1031 exchange, which means that, again, you're buying a property that's equal to or greater in value than the property you sold and defer that tax. Or if it's a primary residence, you get to exclude either $250,000 of the gain, or if you're single, or up to $500,000 of the gain if you're married. That's for a primary. So they're two separate deals. The next question is there a best place to have a long-term rental in Orange County? Great question. So one of the things that I explain to investors is that there is a spectrum of cash flow on one end and appreciation on the other. And I'll tell you what I mean by that. There are certain areas where you can get really strong cash flow, either in the country or in the county, not so much in the county, let's say in Southern California in general, or across the country. You get great cash flow, really good return on investment, lower appreciation, right? You can go to states like Texas where over the long term it sees maybe 2 to 3% appreciation, but gets much higher cash flow. Or you can invest in a place like Orange County where you're going to get a lower cash flow, but we've seen much greater appreciation over time. However, it's also more volatile, right? So again, it goes back to determining, are you more appreciation focused or are you more cash flow focused? Do you need it to be close to home, right by you for your level of comfort and risk tolerance? Or are you open to going out of state? Do you have family members or feet on the ground, people that you trust in that out of state area? Have you built a great team so that you can justify going out of state? The next question is there an ideal cap rate? Yeah, absolutely, as high as possible. What I would say is, again, the more desirable the location, generally speaking, the lower the cap rate. I'm speaking really more Orange County specifically here, but I'll give you an example. You can probably buy a duplex. In fact, I've seen these deals before. You could buy a duplex or say a 3-unit, in Newport Beach, on the sand or real close to the sand, crummy cap rate, maybe 3%, 3.25%. You can go a little bit more inland, to some parts of Costa Mesa where maybe you're going to get a 4.5, 4.75 cap rate. Or you can go, say, to parts of Long Beach, where you might be able to get 5, 5.5, maybe even stretch it almost to 6. Even better, you can go to the Inland Empire. I just looked at a deal today that was out in San Bernardino that was like, gosh, I think it was an 8 or a 9% cap rate. What's the downside? It's in San Bernardino. There's a little bit more risk. There's no constraint on supply. There's a lot of open land. People can always keep building. Orange County is much more protected from the stance that there's not a lot of places to build. And so that supply, there's always a natural constraint on supply. Do we have any other questions? Would a retired person living off a pension and Social Security be able to get financing? Yeah, that's a great question. It's a little bit more specific in the lending lane, so I'm going to speak without full authority, but I believe the answer is yes. I believe that whatever you have coming in as income, even if it is Social Security or pension funds, can be considered income. What the lender would then look at is what is the total income, and then what's the debt to income ratio. In other words, the thing that you want to buy how does that payment line up with what the income is? And is it 43% or less? That's with a conventional lender. If you're going again to more of your portfolio lenders or hard money lenders, credit unions, there may be other options available that would work better for that situation. But the short answer is yes.